For our next example, suppose that Sean sells his vacation cottage for a price that is $75,000 more than he paid for it. Most or all of that $75,000 gain could be subject to capital gains tax. Capital gains tax is a form of income tax that specifically targets investment profits. 2 years later, Sean sells a collection of artwork that he acquired in the past. Unfortunately, the market for artwork has softened over the years, so Sean has to sell the artwork at a $55,000 loss. The IRS allows taxpayers to use capital losses, like Sean's bum deal on the artwork sale, to reduce their total taxable income, but only to a very limited extent. For the year when he sold the collection, he might only be able to deduct a few thousand of the $55,000 loss from his total income. He may have the option to carry the unused part of the loss forward to future years, but at best, this process would mean taking many years to deduct the full loss amount. The tax rule at issue here is that while the IRS strictly limits how much of a capital loss you can use to offset general income, there is no set limit on using capital losses to offset capital gains. Therefore, Sean could have benefited greatly by selling both the cottage and the artwork the same year. He could have then used the entire loss on the artwork sale to offset much of the gain on the sale of the cottage. So instead of paying capital gains tax on $75,000 one year, and later spending many years trying to slowly use up a $55,000 capital loss, Sean might have only had to pay tax on a net capital gain of $20,000. The resulting tax savings could be substantial, and he would avoid all the hassles of stringing a loss out across years or even decades. In these examples, not having a multi-year tax plan could cost both Karina and Sean thousands or tens of thousands of dollars in the end. Focusing only on the size of their tax refunds for a particular year, when they had already made disadvantageous choices, would be barking up the wrong tree. Importantly, since the goal is lifelong tax savings, long-range tax planning should also take your retirement goals into account. For example, the choice between a traditional or Roth IRA has major tax implications both now and far into the future. A full breakdown of IRA options is beyond the scope of this video. But very briefly, contributions to a traditional IRA are often sheltered from federal income tax, while withdrawals from the account typically get taxed. For Roth IRAs, the reverse is true. Contributions to the account generally get taxed, while qualifying withdrawals may be taken tax-free. The more thoroughly you evaluate your short-term and long-term income and tax prospects, the easier it will be to choose which type of plan is best for you. We would be happy to work with you to develop long-term tax strategies that take into account tax credits and deductions, capital gains and losses, retirement plans, and many other factors. Taking a few planning steps now could pay dividends for decades to come. Summing up, thoughtful annual and multi-year tax planning can help you change that yearly coin flip into a long game tilted to your advantage. If you have any questions or would like to learn more, please get in touch by calling or filling out the contact form. It will be a pleasure speaking with you about your unique circumstances and needs.